Very pleased now to be joined by Rupal Bhansali, Chief Investment Officer, Global Equities, and Fund Manager at Ariel Investments. Rupal, it's great to have you back on Worldwide Exchange. Thanks very much. We heard from Jay Powell. We've got some data that shows inflation may be cooling off a bit, still hot historically. Where do you really see inflation now, and where is it heading in the next 6 to 12 months?
Brian, I think we are still very data dependent, and I think people are reading too much into what Jay Powell said yesterday. I think he remains hawkish, and I think that the forward curve, even though it's improved a bit, it's still at very elevated levels. And so I think it's premature to call a verdict on what inflation is going to peak at. And I certainly don't want to be one of those people to make that prediction. But I think it's going to be higher for longer, and that's a challenge for markets.
Does that mean the Fed will be more aggressive for longer?
I'm not sure it'll be more aggressive, but even if it is slower, I think it's premature to call a victory on inflation. I think we're going to be higher for longer, and that's bad news for equity markets. Because if you think about real estate, if it's about location, equities is about earnings. And so whether we have an economic recession that's soft or hard, I think we're going to have an earnings recession next year, and that's what I would suggest investors be focused on.
Yeah, because there does seem to be this theme in the market where, and maybe we've been so trained on this, Rupal, that the Fed's either going up or it's going down. That's kind of been the way it's been for a long time now. And everybody thinks, well, when they stop hiking, maybe they'll start cutting. Feels like you would disagree, which means equities would go up. Feels like you would fundamentally disagree with that.
I think people are being penny wise, pound foolish. It's not about rate change. It's about a regime change. The thing I would focus on more is quantitative tightening versus quantitative easing that we had in the last decade. And QT is very painful and very tortuous. We already saw the impact it had on the mortgage bond market. The moment the Fed stopped buying mortgage bonds, rates shot up way higher than I think anybody anticipated or expected. And I think a similar development occurs with respect to the entirety of the yield curve around the world, because the US tends to send the benchmark rates for the world. We are likely to be in a higher for longer scenario for a couple of years. And that bodes poorly for equity markets that are not prepared for that outcome.
Is that just your global equities? So are you talking about global equity markets? Are you talking about the U.S. stock market, or are there parts of the world that you do like?
Globally, we are headed for a recession. It's probably going to be a rolling recession. We already have one in China, as we all know right now. It's spreading to Europe. It'll soon spread to the US, and that will become a global recession, which will create an earnings recession. And I think consensus estimates for 2023 and 2024 earnings are a bit too high, and they need to come down at least by double digits. And when earnings come down, multiples also derate. The other thing I would point out is, for a long time, the market has supported equity investing because of TINA. There is no alternative. Well, now there is. We are now in TN, which is the treasuries are giving you 4% rates of interest. That's a lot of competition for an equity market like the S&P 500, which only gives you a 1.5%.
Yeah. I'm going to be in Europe most of next week, Rupal, covering the EU oil sanctions, potential price caps, what's going to happen with their energy crisis in 2023 and beyond. It's not really about this winter, it's about next year. And there's this view that everything's fine because, the storage levels are good. No, half the storage was filled up in natural gas by Russian gas, which is no longer available. And so I don't know, I'm really worried about maybe Europe can muddle through, but from an economic perspective, it seems hard to see how their economies can prosper. And that's an economy that's effectively together the same size as the United States. Are you worried about Europe economically?
I'm worried about the world economically because we are headed into a geopolitical situation of deglobalization, and deglobalization is generally inflationary in nature. And that's my concern for markets at large, that we have been used to an environment where for 40 years, inflation was, falling or disinflationary or under control. And I'm not convinced that we have the cat in the bag going forward. There are too many inflationary forces, one of which you mentioned, which is the inability to source cheap fuel is going to hurt a lot of industries vicariously. Europe is just the beginning of that. Deglobalization means higher costs. And that's something the markets need to be prepared for because it affects corporate profit margins.
Okay, so leave us with a little bit of opportunity. I mean, your job is to protect your clients' wealth, grow your clients' wealth, as well as is it just only maybe about short-term treasuries and cash right now, or are there some areas that actually do look attractive?
No, in fact, I agree with you. Our job is to provide, where is there investment opportunity? I am finding it actually in pockets of the market. I'm not a macro investor, but, value tends to cluster. It is clustering in the UK. A lot of the bad news politically and economically in the UK, I think, is already in the price. And there are very good dividend yields available in that market. And Brazil and Latin America is also very well positioned for upside because they are commodity exporters. And to the extent that commodities has been causing inflation, they benefit from it as opposed to suffer from it. So, of course, there are opportunities, but they're not in the conventional places that people look at.
Are you buying Brazilian equities then? Or are you buying Brazilian debt, or both?
Well, I already bought, because we try to look ahead and not think of things just contemporaneously. But I would say that there is still opportunity for other investors to look for bottoms-up stock picking. In particular, you asked about, how would you position portfolios for this environment ahead? I think two strategies that make sense. One is dividend yielding strategies, and second is low vol strategies, both of which happen to be things that I position for in my portfolios already, the Ariel International and Global Equity Mutual Fund. And if people want to know the details of it, obviously it's on the website. But I would say those are the two attributes I would look for the most. The things I would be very suspect or wary about is leverage and liquidity. Any business model that depends upon leverage is going to be finding itself into trouble. And then liquidity, I think, is not going to be plentifully available next year and the year after. And so asset classes that are illiquid will probably suffer from an illiquidity discount than a premium. These are not the kinds of things that people conventionally look at in portfolios, which is why I'm flagging them as blind spots.